Okay. All right.
Well, how have you been? Nice to see you again.
All right. Awesome. Here.
Oh, thank you.
This is awesome.
Gonna...
Hey, you. Come sit. Good.
Quick rundown. I'm sorry, we just sat down. For Michael, the mic will be red. For Michael, there's no colors. This is the part that you're going to want to pay attention to. And then for the members that are going to be on the platform, you can look at this. No, press it, and then when it's on, it'll be red.
Yeah, thank you. Not too hard. Do you have the thank you. And what? Oh, great, thank you. Great, thanks. Yep.
The focus is the importance of having secure digital ID which sort of has to be government issued and has to be issued on some international basis. And then for crypto assets with volatile values, you also need market sector. You don't need market sector. So that's the second thing. How do you ensure that there is trade about that? For everyone trading in I think there's a lot of
It's great to meet you. Oh, awesome. Ryan told me all about you. He told me you were one of the most impressive lawyers he's ever met. He speaks so highly of you. Yeah. I just saw Ryan in Miami. Yeah, because of Art Basel and all of that. It was really nice. So great to meet you. I have a DC association called ADAM, the Association for Digital Asset Markets. So yeah. Proud to have
I will do that.
Thank you. I was like, you know what? We might as well go in style. Do you want a lace one? You want lace? We can get you one of these too, Mark.
The meeting will come to order. Without objection, the chair is authorized to declare a recess of the committee at any time. I now recognize myself for 5 minutes to give an opening statement. Today's hearing is part of this committee's ongoing review of digital assets. Earlier this year, I created a digital assets working group of Democratic members to meet with leading regulators, advocates, and other experts on how these novel products and services are reshaping our financial system. This hearing, subsequent hearings on this topic will help this committee consider how to support responsible innovation that protects consumers and investors, safeguards our financial system from systemic risk, promotes financial inclusion, addresses environmental contents, as well as to consider a potential central bank digital currency. We have also held several subcommittee and task force hearings earlier this year to better understand the landscape of this industry. At today's hearing, which I worked with a ranking member, McHenry, to organize, I look forward to engaging directly with this panel of cryptocurrency CEOs whose companies issue stablecoins and provide an exchange to buy and sell digital assets, to understand where they think their products, services, and technologies are heading. Americans are increasingly making financial decisions using digital assets every day. Even some pension funds are beginning to invest in cryptocurrencies on behalf of retirees, despite the track record of volatility of cryptocurrencies as investments. The pandemic has also continued to contribute to working families looking for alternatives to rebuild their nest egg by investing in cryptocurrency. The rapid growth of this industry has also become more visible with celebrity endorsements and ATMs that exchange cash for cryptocurrency. However, several questions remain as to how traditional rules apply and whether regulators have sufficient authority to protect investors and consumers while maintaining market integrity and encouraging innovation. Currently, cryptocurrency markets have no overarching or centralized regulatory framework, leaving investments in the digital aspect space vulnerable to fraud, manipulation, and abuse. Some cryptocurrency market exchanges and stablecoin issuers have obtained state money transmitter and sale of checks licenses from multiple states, and at least 3 cryptocurrency companies have obtained conditional approval for national trust bank charters from the Office of the Comptroller of the Currency. Meanwhile, the Federal Reserve is conducting research on central bank digital currencies, and other federal agencies like the FDIC and NCUA have announced requests for information from the digital assets industry. The SEC also actively utilizing its existing authorities to carry out enforcement actions against market participants. As the prevalence of cryptocurrency grows, it has also raised environmental concerns tied to the computing power needed to mine some of the coins, which can rival the energy needs of entire countries like Sweden or Argentina. At the same time, the promise of digital assets in providing faster payments, instantaneous settlements, and lower transaction fees for remittances are areas that our committee is exploring. As more and more people invest in and use cryptocurrencies, the committee will continue its efforts to look at how they are affecting many aspects of our lives and our financial system. And so with that, I now recognize the ranking member of the committee, the gentleman from North Carolina, Mr. McHenry, for 5 minutes.
Thank you, Madam Chair. 2021 was the year of the cryptocurrency. More Americans than ever are taking notice of this transformational technology. DeFi, DAOs, NFTs, Web3, jargon that was really once just used on crypto Twitter, they are quickly becoming part of the lexicon. Technology and its adoption are moving fast. Entrepreneurs and innovators are building and deploying the next generation of the internet. And firms like the ones before us are the on-ramp for many Americans to participate in the digital asset ecosystem. But this panel is only a bit of that broad ecosystem, and this is the first time Congress is having a hearing about cryptocurrencies in its fullness. But as with any new and fast-growing industry, there are questions that need to be answered. I want to be clear, though. This technology is already regulated. Now, the regulations may be clunky, they may not be up to date. I ask my friends, my policymaker friends here on the Hill, this question. Do you know enough about this technology to have a serious debate? Now, if the answer is no, then we need to first seek to understand, to build up that understanding of this new technology so we can have a serious debate on how we appropriately respond and update regulations and perhaps laws. But I should be clear, the goal today is to listen, learn, and ask questions. This technology is new and exciting. It promises a new direction for financial economies, services, and products. I further ask this question, though, how do we make sure as American policymakers that this cryptocurrency revolution, this technology revolution, happens in the U.S. and not overseas? There are a lot of questions we have to answer. But of course, we need reasonable rules of the road. We know that. We don't need knee-jerk reactions by lawmakers to regulate out of fear of the unknown rather than seeking to understand. And that fear of the unknown and the move to regulate before understanding will only stifle American ingenuity and put us at a competitive disadvantage. Throughout history, we've seen examples, countless harmful examples of overregulation around the world by governments. In the late 1800s, England reacted to the rise of cars with laws that required 3 people to operate vehicles at all times. 1 to drive, a 2nd to fuel up the vehicle, and a 3rd to stand in front of the car and wave a red flag. Now, Congress should not be dumb enough to raise a red flag around this technology revolution. We should embrace it, we should understand it, and we should be the international leaders in this space. Further example I would tell you is Skype, the video conferencing platform that may still be a little clunky, but was vital during the COVID shutdowns that we just experienced. And it was vital for some of our kids to even go to school or even have hearings on this massive screen here. Skype was illegal in most of the world when it was launched. There wasn't a regulatory infrastructure in place that allowed this novel technology, this new technology. And finally, when an invention called the internet began to boom, U.S. lawmakers and regulators struggled to fully grasp the immense possibilities of this innovation out the gate. Now, that was the early 90s, and I think we're in a similar state with Web 3 30 years later for Congress first to understand before we would seek to legislate. Now, it would be nearly impossible to go a day without using the internet to communicate, we know that, or move from point A to point B, we know that, or purchase necessities for our families, we know that. I would argue that the nascent technology we're discussing today will have just as much impact on our daily lives, perhaps more. And that's why we must get this right. My fear, however, is that we'll have a partisan divide here. Well, my fear is that some of my Democrat colleagues have already made up their minds, and they have regulatory bills that they're going to file in order to stifle this innovation or to kill it before it fully grows and blossoms. I hope we can work together in a bipartisan way, and I hope this hearing is first of many for us to understand and get clarity from innovators and entrepreneurs about what is needed. This will allow us, which I think should allow us to have these markets thrive and grow while protecting our consumers and giving clear rules of the road to prevent fraud and manipulation. Forcing the private sector to navigate unclear public statements and regulation by enforcement is the wrong approach. So is demonizing an entire industry based off the headlines garnered by a few bad actors. Understandably, there are concerns with the use of cryptocurrencies for nefarious activities. Let me address that. You know what else is used for nefarious activities? Cash. So let's dispel the rumor now that digital asset technology is a looming threat to our financial system. Instead, we should work to fully understand the opportunities the next generation of the internet could provide to Americans. I look forward to hearing from our witnesses. I look forward to having a deeper understanding as a policymaker about the ramifications for action by Congress before we understand this new technology that is now actually a decade old. So with that, Madam Chair, thank you for having the hearing. Thank you for working with us on a bipartisan panel. And I hope members will take the same spirit of bipartisan cooperation in their questioning and their seeking to understand. With that, I yield back.
Thank you very much, Mr. McHenry. I believe that this hearing itself and the witnesses that we have here today have answered all of your questions about whether or not you think we are seeking information to arm ourselves with the ability to make the right decisions. First, we have Mr. Jeremy Allaire, co-founder, chairman, and CEO of Circle. Next, we have Mr. Samuel Bankman-Fried, founder and CEO of FTX. Next, we have Mr. Brian P. Brooks, CEO of Bitfury Group. Next, we have Mr. Charles Casarella, and CEO and founder of Paxos Trust Company. Next, we have Ms. Danielle Dixon, the CEO and Executive Director of Stellar Development Foundation. And last, we have Ms. Alicia Jean Haas, the CEO of Coinbase Incorporated and CFO of Coinbase Global Incorporated. Without objection, your written statements will be made part of the record. You will have 5 minutes to summarize your testimony. You should be able to see a timer that will indicate how much time you have left. I would ask you to be mindful of the timer and quickly wrap up your testimony when your time has expired. Mr. Allaire, you are now recognized for 5 minutes to present your oral testimony.
Good morning. Chairwoman Waters, Ranking Member McHenry, and members of the House Financial Services Committee, thank you for the opportunity to share my testimony with you today. My name is Jeremy Allaire, and I'm the co-founder, chairman, and CEO of Circle Internet Financial, a now 8-year-old company that has operated at the cutting edge of the digital assets market and digital currency technology innovation. Today, we're at a pivotal moment in the development of the next major infrastructure layer of the internet, extending from an internet of data, content, and communications to an internet of value exchange and economic coordination. In a world where money becomes a core feature of the internet, the United States should be aggressively promoting the use of the dollar as the primary currency of the internet and leverage that as a source of national economic competitiveness. Circle's mission is to raise global economic prosperity through the frictionless exchange of financial value, creating a world where financial inclusion, responsible financial services innovation, and protecting the integrity of the global financial system are not conflicting objectives. Today, I'd like to address some of the key policy issues facing the United States around the rapid growth and use of dollar digital currencies, also known as stablecoins. Circle is the sole issuer of USD Coin, or USDC, an innovation that brings the benefits of digital currency, fast, inexpensive, highly secure, global, and interoperable value exchange over the internet, without the downside of extreme volatility that has plagued most cryptocurrencies. USDC is helping to pave the way for digital dollars to be the leading currency of the internet. While stablecoins got started as a dollar settlement layer for digital asset trading markets, their use in everyday payments is expanding rapidly. Just in the past several weeks, Circle has signed on institutional customers who are using these services for small business payments, international remittances, and efficient payments for remote workers. Soon, we believe that dollars on the internet will be as efficient and widely available as text messages and email. As the recent President's Working Group report on stablecoins highlighted, not all of these payment instruments are created equal. But by the same token, not all of them are part of an unregulated Wild West, as has often been portrayed. In our case, we have prioritized building, designing, and guarding the prudential standards for USDC inside of and conforming with prevailing U.S. regulatory standards that apply to leading fintech and payments firms. This approach has helped USDC to reach over $40 billion in circulation and has powered more than $1 trillion in on-chain transactions. The reserves backing USDC are held in the care, custody, and control of the U.S. regulated banking system. These are strictly held in cash and short-duration U.S. government treasuries, and we have consistently reported on the status of these reserves and their sufficiency to meet demands for USDC outstanding with third-party attestations from a leading global accounting firm. With this growth comes an increasing responsibility to foster financial inclusion. To that end, we aim to deploy cash deposits across the country where we will allocate a share of USDC reserves, hopefully accruing to billions of dollars over time, to minority depository institutions and community banks as a way of improving their balance sheets, but also ensuring that the future of payments and banking is more inclusive than the past. The President's Working Group report on stablecoins has put forward a set of recommendations for establishing national regulatory supervision of firms such as Circle. We support this effort and believe there can be strong nonpartisan support for the appropriate federal supervision of this highly strategic payments infrastructure. Well prior to the President's Working Group report, we announced our plans to pursue a national banking charter from the OCC, and we continue prioritizing active engagement with all of the relevant federal and state banking regulators. There's much work to do in defining the critical statutory requirements for stablecoins. At the same time, the technology of blockchains and digital assets are not standing still. And whatever the ultimate policy and regulatory outcomes, it is crucial that policy embraces and enables the United States to be global leaders in the development of the Internet of Value. As the committee works in earnest on these issues, we welcome active engagement and believe this to be one of the most important areas for economic infrastructure and growth in the coming decade. Thank you again, Chairwoman Waters and Ranking Member McHenry, for the opportunity to present to you today. I look forward to the committee's questions.
Thank you, Mr. Allaire. Mr. Bankman-Fried, you are now recognized for 5 minutes to present your oral testimony.
Thank you, Chair Waters, Ranking Member McHenry, and all the members of the committee for having me here today to testify. It's an honor to be here. A little bit about my background first. I grew up in Stanford, California, went to MIT where I majored in physics, and spent 3.5 years as a quantitative trader after college. My goal has been to find ways to have positive impact on the world and to maximize that, and to do so by supporting some really fantastic organizations. In 2017, I felt like it was time to try starting up my own thing. So I left my job and I moved out west and ultimately got involved in the burgeoning cryptocurrency ecosystem. I spent about a year trading, and in late 2018 began with my co-founders building out FTX. FTX is a global cryptocurrency exchange. We are the second or third largest exchange globally, depending on what metrics you use, processing about $15 billion per day of trading volume on the platform. About a year and a half ago, we started up FTX US, our United States-based and servicing operations. A few points on FTX and the broader cryptocurrency industry. The first is that I think that the industry has the potential to improve a lot of people's lives. There are a lot of ways that this can happen. I think that the payments side of this gets a lot of attention, and rightfully so. Every time that a common consumer goes to a market to purchase goods, they pay multiple % in fees to intermediaries, and that's if they're lucky. When you look globally, trying to send money back to your loved ones at home is extremely difficult. It can cost tens of % in fees. It can take weeks to arrive. It can get embezzled by various third-party scams in the middle. And in general, the global financial ecosystem is not one where sending assets to those who are important to you is easy to do. And this hits the people who are least off the hardest, who have the least access to the financial ecosystem as it exists today. When you look at the number of people who are underbanked or unbanked, both in the United States and globally. It's indicative of a system that does not work for everyone. And this is a product of the intermediation involved. It's a product of how the larger institutions have evolved. And it's a product of payments infrastructure that is difficult and clunky enough to use that it just does not work for most people. Cryptocurrencies do provide a potential way to address a number of these issues, making it easier, cheaper, faster, and more equitable for people to do what they need to do to manage their financial lives. A little bit about FTX. We are a cryptocurrency exchange. We have a different structure than the traditional exchanges do, as do many digital asset venues. We provide open and free market data to all of our users. On a traditional venue, you pay tens of millions of dollars per year if you want access to the data of the market that you're expected to be placing orders in. You have minimal access to the same tools and order types that sophisticated trading firms have if you're accessing it through the normal set of intermediaries. On FTX, all of our users have full access to the platform. They have full access to the same sets of tools that institutions do. And they have full access to all of our market data, which we make publicly available for free. This is true whether you're accessing it via API as a sophisticated institution, via our website, or via our mobile app. We've also put a lot of work into the risk controls on our platform. This is true from the financial crime side, where we conduct sophisticated know your customer diligence on all of our users. In order to identify any illicit activity, we monitor via multiple solutions all blockchain transfers into and out of our exchange. It's true of our risk engine, which is a 24/7 risk engine that is unlike the traditional financial ecosystem where risk builds up overnight, where there need to be separate risk models for weekends and overnight activity and holidays, where hours or days can go by with no ability to mitigate risk to the system. We have a transparent system where all of our data all of our public market data is openly available and free, where risk parameters are transparent. And we are already regulated and licensed. We have many licenses globally. Here in the United States, we are regulated by the states under the money service business and money transmitting regime. And we are regulated nationally by the CFTC, where we have a DCO, a DCM, a swap execution facility, and other licensure. We strive to conduct all of our business in a transparent and regulated manner. I think that it is coming, and I think it is important, and I think that it's healthy that the industry will be regulated. I think it is also already regulated in a number of ways. I think that there are points that need to be addressed to give oversight of various aspects of the industry that do not have sufficient oversight right now. And I also think that it is important to do so in a reasonable and common sense way that understands the industry. I'm happy to answer any of your questions.
Thank you very much, Mr. Bankman-Fried. Mr. Brooks, you are now recognized for 5 minutes to present your oral testimony.
Thank you, Chairwoman Waters, and Ranking Member McHenry and members of the committee. Thank you very much for having me here today to talk about digital assets and the future of finance. The topic is an important one for anyone who cares about American competitiveness in the financial services sector, a financial ecosystem that empowers users over bank CEOs and other powerful central decision makers, and the next iteration of the internet in which individuals are able not only to read information and write content, but also to own a piece of the networks themselves. I am CEO of Bitfury Group, a company that provides a suite of infrastructure products and services that support various aspects of the cryptocurrency ecosystem, an ecosystem many of us today refer to as Web3, since crypto assets generally represent either the rewards paid to participants for maintaining a particular decentralized network or an app that operates on such a network. Since 2011, Bitfury has designed and produced 8 successive generations of ASIC chips and related equipment for conducting transaction validation activity on the Bitcoin blockchain, a process known informally as Bitcoin mining. Along the way, Bitfury developed a series of adjacent businesses to make crypto assets safe, sustainable, and useful. Our various businesses include LiquidStack, one of the world's largest immersion cooling systems, focused on reducing the energy used in Bitcoin mining and other high-performance data centers by as much as 90%. Crystal, a blockchain analytics company that provides transaction monitoring and related compliance tools to more than 150 law enforcement agencies, crypto exchanges, and financial services companies in Europe, Asia, and North America. Accelera, a producer of cutting-edge artificial intelligence ASIC chips, and others. I believe the committee's topic today requires an understanding of three important threshold issues. First, a national policy agenda that takes crypto compliance seriously should assess whether it makes more sense to continue to keep crypto activities largely out of the regulated financial system, or whether it makes more sense to bring them inside the system precisely so that they can be supervised and operated with appropriate levels of risk management. For example, is it consistent to take the position that only banks should be allowed to issue stablecoins, but then fail to grant bank charters to the largest issuers of stablecoins? That would, after all, bring stablecoin activity within the ambit of an existing national bank supervision system with which we're all familiar. Or does it make sense to bring enforcement actions challenging certain crypto assets as unregistered securities, but then fail to allow those assets to be registered and trade on a national securities exchange subject to supervision by FINRA and the SEC? Second, Americans deserve to know what our national policy is for a decentralized Web3 powered by crypto assets. Treating crypto as a single unitary activity whose main feature is a need for financial regulation would be like treating the original internet in the 1990s as primarily a tax policy issue. We didn't do that then. What we had in the 1990s with respect to Web 1 that we lack today with respect to crypto is a comprehensive national policy predicated first on the notion of do no harm to the emerging network. Today, instead of focusing only on micro questions, such as whether a particular token is a security or whether a particular exchange-traded fund may be offered, it would be worthwhile for the elected branches of government to grapple with the bigger questions, such as, do we believe a user-controlled decentralized internet is better than an internet largely controlled by 5 big companies? Do we believe that the financial services sector is any less subject to network effects than information and commerce were in earlier iterations of the internet? Do we trust big banks more or open source software more as a tool for maintaining ledgers of account and allocating credit and capital? Can we recognize the difference between crypto projects failing for lack of demand, just as many publicly traded companies fail, and the difference between individual crypto projects actually being scams unworthy of being presented to the fair but sometimes harsh judgment of markets? Third, crypto policy should take into account not only any new risks introduced into the system, but also the risk in the present system that are solved by decentralization. Having issued almost $1 billion in civil money penalties against banks and bank executives during my tenure leading the Office of the Comptroller of the Currency, it is clear to me that the present financial system has plenty of examples of risks and costs and safety and soundness problems that are being addressed in the current system. Shouldn't we take seriously the possibility that algorithms and open source software that take a measure of human error, greed, negligence, fraud, and bias out of the system might actually make the system better on net, even if there are some new risks being presented that need to be understood and regulated? Apart from those three overarching considerations, I'd like to very quickly make 2 points specific to my current perspective on the crypto economy. One relates to the effect of U.S. crypto regulation on American competitiveness in both the technology and capital markets sectors. There are a number of examples of U.S. regulatory decisions that have driven legitimate activity offshore in ways that harm U.S. investors, innovators, and workers. Can anyone explain, for example, why Fidelity Investments, one of America's best-known investment advisors, had to go to Canada to offer a Bitcoin ETF? Or why physically settled crypto ETFs are safe and legal in Germany, Brazil, Singapore, and elsewhere, but somehow not in the United States? Can anyone explain why crypto exchanges, stablecoin issuers, and others can receive e-money licenses to access the payment system in the United Kingdom, but in the United States are reserved exclusively for chartered banks, with the result that the GDP cost of the payment system in the US is roughly 4 times the cost in the UK? For that matter, why is there no clear path for crypto-focused insured depositories chartered in the state of Wyoming to access Federal Reserve payment services like other insured depositories? These are the big questions that I hope to address today. Thank you, Madam Chairman, Ranking Member McHenry.
Thank you, Mr. Brooks. Mr. Casarelli, you are now recognized for 5 minutes to present your oral testimony.
Chairwoman Waters, Ranking Member McHenry, and members of the committee, Thank you for this opportunity. My name is Charles Cascarella. I'm the CEO and co-founder of Paxos. During my 22-year career in financial services as an analyst, investor, and entrepreneur, I have witnessed the shortcomings and systemic risks of our financial market infrastructure firsthand. Paxos is a regulated financial institution and blockchain infrastructure platform. Paxos' customers include Bank of America, PayPal, MasterCard, Interactive Brokers, Credit Suisse, and many others. We help financial institutions provide their clients with reliable, regulated access to digital assets. Paxos also offers a uniquely structured and regulated stablecoin, the Pax Dollar. Each Pax Dollar is fully backed by $1 US. As a result, it is not volatile like other types of digital assets. However, it retains the same properties that make digital assets so appealing. It can be transferred nearly instantly, overnight, and on weekends, and it is programmable, secure, and traceable. Digital assets and blockchain technologies can create a more efficient, secure, and innovative financial system, and a more inclusive and equitable global economy. In the existing financial system, a person needs a bank account to safely store money, establish credit, earn interest, and borrow. Yet according to the Federal Reserve, 18% of all Americans and 40% of Black adults and 50% of adults without a high school degree are unbanked or underbanked. The current system is expensive and slow. International and even domestic money transfers can take days. At any given time, there are trillions of dollars worth of capital held up in transactions that have not yet settled. Digital assets are vastly more accessible. Anyone with a smartphone can download a wallet app to send and receive assets. No bank account is required. Transferring digital assets is instantaneous and convenient. They can be sent or received 24/7. There's no waiting around for wire transfers or money orders to arrive, or for banks and stock exchanges to open. And transfers are often very inexpensive, in some cases costing just a penny per transfer. Digital assets can also reduce bias in finance. At its heart, blockchain is just a math equation. It is agnostic to a user's race, gender, nationality, or income. And blockchain permanently and publicly records transactions, reducing errors, fraud, and systemic risk. A blockchain-based financial architecture could settle trades on the same day, thus mitigating counterparty risk and eliminating the need for costly central clearinghouses. For our part, Paxos recently completed a successful pilot to offer same-day security settlement in support of SEC Chair Gensler's goal of reducing settlement times. Paxos believes regulation is essential for increasing public trust in digital assets and ensuring adoption. That's why we sought oversight by a primary prudential regulator, even though we were not required to do so. Paxos became the first regulated trust for digital assets in the country when it was approved by the New York State Department of Financial Services in 2015. We adhere to the same anti-money laundering and know your customer rules as banks. We are subject to regular examinations of our operations, procedures, and capital levels. Our products are also regulated. Of the world's 3 regulated dollar-backed stablecoins, 2 are issued by Paxos. Unfortunately, the uncertain state of digital asset regulation is hampering the industry's development. The solution is not to shoehorn digital assets into a regulatory system designed for earlier generations of financial assets. We have an opportunity to build a more efficient and effective financial system. We believe a primary prudential state or federal regulator should regulate digital asset companies and their products. Compliance standards need to be enforced. Regulation must ensure that customer assets are held segregated from the company's balance sheet. For stablecoins, independent auditors should regularly attest that assets backing the token are always held in reserve. Those reserves should be held in bankruptcy remote accounts and available to the issuer and not available to the issuer's general creditors. If the federal government instead stifles the adoption of digital assets, issuers, talent, and capital will flee for more welcoming jurisdictions. That would be a disaster for Americans, both consumers and workers, and our economy as a whole. Without regulated U.S. dollar-backed stablecoins or a central bank digital currency and the infrastructure to support them, it will become increasingly less viable for other countries and companies to continue using the U.S. dollar as the global reserve currency. We need the government support to create a new, more secure, more competitive financial system. The benefits of getting this right are enormous, but so are the consequences of getting it wrong. Thank you for the opportunity to provide my testimony, and I look forward to your questions.
Thank you very much. Ms. Dixon, you are now recognized for 5 minutes to present your oral testimony.
Good morning, Chairman Waters, Ranking Member McHenry, and members of the committee. Thank you for inviting me to be here today.
Could you move your microphone a little bit closer? Thank you.
Thank you for inviting me to testify today. I'm honored to be here. My name is Danielle Dixon, and I am the CEO and Executive Director of the Stellar Development Foundation. I took this role and joined the blockchain industry more than 2.5 years ago. Prior to that, I was the Chief Operating Officer of the Mozilla Corporation, where I spent a lot of my time advocating, among other things, openness and interoperability in web technologies. It's those same policy priorities that drew me to blockchain, an industry that I believe can learn from past mistakes made in other areas of web development. Stellar is an open, permissionless, decentralized network that is optimized for payments. There is no single entity, including SDF, that controls the code base of the network or its growth. You don't need permission to use this technology. Just like the underpinnings of the internet, it is ready and available for use to anyone. Importantly, and especially in the context of this hearing, Stellar was designed for asset issuance, making it possible to create, send, and trade digital assets backed by nearly any form of value. And also is designed with compliance tools built in to help those asset issuers meet their own compliance obligations. The Stellar platform is a pioneer of tokenization, optimized for fiat-backed asset issuance before stablecoin was even a word. And over the last few years, an ecosystem of businesses and users have built use cases around Stellar-based stablecoins due to their incredible utility to solve many of the problems we see in today's payment landscape. Despite the headlines, what's happening in the world with blockchain, with cryptocurrency, and stablecoins is not just lending, trading, and borrowing. Other use cases are active and focused on solving real-world challenges using the technology. So let me start with Moneygram International. Moneygram is building a solution on Stellar that enables seamless conversion between cash and digital assets. Moneygram's network integrates with the Stellar blockchain to enable cash funding of digital accounts and payout in different currencies of the consumer's choice using stablecoins. It's using Circle's USDC coin. In real terms, consumers will be able to send value in the stablecoin and easily convert to local fiat currency for instant pickup of thousands of participating Moneygram locations globally. This is in pilot phase right now in the US and is expected to be widely available in 2022. Another example, Leaf Global FinTech has built a solution for refugees and cross-border goods traders who are vulnerable to theft while carrying across borders. So with Leaf's wallet, these users can save their money in multiple currencies, benefit from cross-border transfers, and pay for goods and services. That functionality is only possible because they leverage Stellar's ability to issue assets, to issue stablecoins, and exchange value with low transaction fees and high speeds. This use case is live and operational today. The last use case I'd like to touch on is one that is in development. Tala is best known for its mobile lending app, which enables its customers to apply for a loan and receive an instant decision, regardless of their credit history. Tala is now working to expand their offering by using Stellar assets and stablecoins to help their current customers with credit by allowing borrowing, spending, saving, investing, and sending and receiving. There are many more valuable use cases that's in the Stellar ecosystem that I would love to be able to share with you today. But I would just briefly like to mention that in a recent report from the G20 and IFC, there were 5 Stellar ecosystem companies named for their innovative solutions in digital finance supporting MSMEs. Use cases like these are in varying states of maturity, but their current and potential value is undeniable. And none of these use cases would be possible without stablecoins. Stablecoins are a core technological component, and by extension, that means stablecoins are essential on delivering on financial inclusion. So that brings me to the PWG report on stablecoins. The PWG report raises legitimate risks, but its recommended solutions, they go too far. Specifically, to limit stablecoin issuance to insured depository institutions is not narrowly tailored to the actual risk of stablecoin arrangements for the simple reason that although there are outliers, most stablecoins, unlike bank deposits, are fully reserved. Instead, we advocate for a regulatory approach that it focuses more on stablecoin reserves by requiring stablecoin arrangements be fully reserved by appropriate assets, requiring reserves to be held as insured depository institutions, creating clear standards for regular audit and public disclosure of stablecoin reserves and key contractual terms regarding redemption, and by making it clear that payment stablecoins are not securities. Of course, regulators must be empowered to oversee these requirements. The framework should allow oversight through state banking supervision or a narrowly tailored charter of the OCC. In our view, this would promote the safety and soundness of stablecoin arrangements. We've started to see how innovation can be hampered in other parts of the world when regulators and lawmakers react prematurely. In Nigeria, stablecoins and blockchain technology were eliminating costly foreign exchange and transaction fees and slow processing times until the Central Bank of Nigeria abruptly ended that business model. And many innovators had consequently been stopped in their tracks. As we walk away from this hearing, I urge you to look at the industry and technology beyond the narrow lens of applications that often dominate the news. Thank you for having me here today, and I look forward to your questions.
Thank you, Ms. Dixon. Ms. Haas, you are now recognized for 5 minutes to present your oral testimony.
Chairwoman Waters, Ranking Member McHenry, and members of this committee, good morning, and thank you so much for this opportunity to testify on digital assets and the future of finance. My name is Alicia Haas, and I serve as the Chief Financial Officer of Coinbase Global. I also serve as the Chief Executive Officer of Coinbase Inc., our U.S. subsidiary. I joined Coinbase in 2018, formerly was Chief Financial Officer of Sculptor Capital and One West Bank, and spent 20 years in the financial services industry. Today, I'm here to introduce Coinbase, talk about the evolution of crypto, and highlight today's regulations and how they could be changed to advance bipartisan goals of protecting consumers and promoting innovation. Coinbase's mission is to increase economic freedom in the world. We were founded in 2012 with the idea that anyone, anywhere, should be able to easily and securely send and receive Bitcoin. Over the last 9 years, our products and services have expanded to meet our customers' needs in the rapidly evolving crypto industry. We have customers in every state except the state of Hawaii, and as a remote-first company, we have employees in 45 states and in the District of Columbia, including 24 of the 25 states represented by this committee. We now securely store 12% of the world's crypto on our platform. This is across over 150 asset types, and we offer customers the opportunity to learn, to sell, to resend, to receive, and buy more than 100 assets on our platform. Additionally, we offer customers the opportunity to spend, to borrow, to earn, to stake, and transact on select assets. We serve more than 73 million customers globally, including 10,000 institutions and 185,000 application developers. Importantly, nearly 50% of our transacting customers are doing something other than buying and selling crypto, which indicates to us that crypto has moved past its initial investment phase, and we are now in the long-expected utility phase of this ecosystem. Since our founding, Coinbase has strived to be the most secure, trusted, and legally compliant bridge to the crypto economy. Coinbase is federally registered as a money services business with FinCEN, licensed as a money transmitter in 42 states, holds a BIT license and trust charter from the New York Department of Financial Services, and we are authorized to engage in consumer lending in 15 states. We have a robust AML BSA program, and we are one of only 2 digital asset members of the Department of Treasury's Bank Secrecy Act Advisory Group. In addition to the various state regulatory regimes, we are subject to federal oversight from Treasury, the CFTC, SEC, FTC, and CFPB. Much like the adoption curve of the internet in the 1990s, we are seeing dramatic advancements in crypto participation. There are more than 220 million crypto holders globally. And around 16% of Americans have invested in, traded, or used cryptocurrency. Total crypto market capitalization at the end of the third quarter was over $2 trillion, up from $800 billion as of the end of 2020. Coinbase's platform is powering the crypto economy, a new financial system for the internet age, which we believe is a critical infrastructure layer to Web 3.0. Technologies like non-fungible tokens, which we call NFTs, and decentralized application platforms will lead the way to Web 3.0, which will revolutionize the internet. Much like the industry was revolutionized when it went from static content to the dynamic engagement content we have today. We believe sound regulation is central to fueling crypto innovation and adoption. That is why we introduced our digital asset policy proposal, which we refer to as DApp. The DApp assessed the challenges of the existing regulatory framework and proposed a 4-pillar solution. First, we believe the government should recognize digital assets under a new, comprehensive framework that recognizes the unique technological innovations underpinning digital assets. Second, the responsibility for this new framework should be assigned to a single federal regulator. This regulator would be charged with establishing a registration process for intermediaries, which we refer to as marketplaces for digital assets. Third, this new framework should have 3 goals to ensure holders of digital assets are empowered and protected. A, we believe in enhanced transparency through robust and appropriate disclosure requirements. B, we want to protect against fraud and market manipulation. And C, we want to promote efficiency and strengthen our market resiliency. Our 4th and final pillar is to ensure that regulatory solutions promote interoperability and fair competition. In conclusion, Coinbase believes crypto will drive transformational change across society in positive ways. This is why our mission is to promote economic freedom around the world. Disruption always challenges the status quo, but we believe sound policies can improve the system for everyone. We applaud Chairwoman Waters, Ranking Member McHenry, and the members of this committee for holding this important hearing. Thank you for the opportunity to discuss these important issues, and I look forward to answering your questions.
Thank you very much. I now recognize myself for 5 minutes for questions. Mr. Casarella, I'm a bit concerned about your company, Paxos's partnership with Facebook, which is now calling itself Meta. As you know, Facebook has attempted several times to enter the cryptocurrency market. Starting in 2019, they founded the Libra Association, based in Switzerland, with the goal of creating a stablecoin, but suspended its activities after this committee held hearings, and I, along with other members and U.S. regulators, raised significant concerns, leading to a number of Libra Association members pulling out. Now, in partnership with Paxos and Coinbase, Facebook has launched a pilot project with its digital wallet, Nova, for a limited number of individuals in the United States and Guatemala to send and receive money using your stablecoin known as USDP or Pax Dollar. As you know, one of the recommendations in the recent President's Working Group report focuses on mitigating systemic risk posed by stablecoins as well as concentration of economic power concerns. The report, among other things, recommends legislation that stablecoin users must comply with activity restrictions that limit affiliation with commercial entities, similar to restrictions most banks face to promote the separation of banking and commerce. While your partnership with Facebook is reportedly a pilot limited to a number of users in Guatemala and the United States, what is stopping Facebook from the future allowing its nearly 3 billion monthly active users to make payments and save funds with a Pax Dollar or other previously issued stablecoin through a Nova wallet? If this were allowed at such a scale, how would this not undermine the U.S. dollar and the world's reserve currency? Casarella, are you still muted? Can you hear me?
There we go. Sorry about that. Thank you for the question, Chairwoman. I think it's important to note in the case of Novi that they are a customer of Paxos just like any other customer of Paxos. We have an open product. They could use that product in the open market. They decided to come to Paxos. And I think they did that because we have the most regulated stablecoin product. And I think that was an important decision for them, that they wanted to use a well-regulated product. And I think another important point here is is Novi is our customer. That's a subsidiary of Facebook Meta. But Novi itself is a regulated money services business. They are regulated to operate in almost all states in the United States. And we have done extensive due diligence on their controls and the regulatory oversight that they have. And we feel very confident that they're following those. And so in terms of the Novi usage of our product, it's just like anybody else, just like if they had a bank account, which they do, and they were using. And so in that way, the services they're getting from us are no different than services they get from any other financial institution that they have a relationship with.
And so this is supposedly a pilot that's limited to a number of users in Guatemala and the U.S. What is stopping Facebook again from in the future allowing its nearly 3 billion monthly active users to make payments and save funds with a packed dollar or other privately issued stablecoin through a Nova wallet? How long is this pilot? Can you describe it?
Yes, the pilot's limited and controlled. It's something that we work together with our regulator on, and they have reviewed our program. Novi would be best position to talk about their plans to expand it. But right now, they're in a pilot phase. It's just the U.S. and Guatemala. It's quite limited in scope and size.
I now recognize the gentleman from North Carolina, Mr. McHenry.
Well, thank you.
Who is a ranking member of the committee. You are now recognized for 5 minutes.
Thank you. Mr. Brooks, let's step back from digital assets and blockchain for a moment. Let's talk about where the internet was, where it's come to, where it's going, right? We're trying to level set here for policymakers. So originally, the internet was a read-only format, in essence. We're consuming information. And then there's additional layers that we place on. It became much more interactive. But counterintuitively, much more interactive, but much more centralized in Web 1, Web 2. What we're hearing now is Web 3. Policymakers need to understand the nature of Web 3. This is a hearing about a component of Web 3. Now, along those lines, what are the characteristics that defined Web 1 and Web 2?
Mr. McHenry, thank you very much for that question. I think that's critical to understanding what we're all trying to build here. So the characteristic of Web 1, if people remember their original AOL account, was an ability to look in a curated walled garden at a set of content that was not interactive but was presented to you on AOL the way that Time magazine used to show you the articles they wanted you to see inside of their magazine. Just you could see it on a screen. The innovation of Web 2 was that suddenly you could not only read content, but you could also write content. This is when the blogosphere became a big thing. People remember this from the late 90s, the early 2000s. The reason for the centralization of the internet, of course, was that all of that activity was being monetized by a very small number of companies. Facebook, as the chairwoman mentions, Google, and 2 or 3 other companies. What makes Web 3 different is the ability to own the actual network. And that's what crypto assets themselves represent, is an ownership stake in an underlying network. So when you hear people talk about, for example, layer 1 tokens, what they mean is this is your reward for providing the ledger maintenance services, the computing power to the network that on Web 1 and 2 was done by Google, right? So now people in my hometown of Pueblo, Colorado can actually own the Ethereum network, but they can't own the internet. That's owned by Google and a few other companies. That's what the project of crypto is all about, is allowing people to directly own the networks that have native assets that are supporting it, and that's the nature of decentralization, where the token holders are the people who control the asset, not
so
Google.
Token holders, for our language here on the Hill, those are digital assets, right, which are the keys to open up the ledger for you to participate, right? Correct. So describe to us how those digital assets fit into this internet revolution, Web 3.
So the concept is that you have sort of application layer tokens and you have protocol layer tokens. So if I'm an owner of Bitcoin, let's say that I'm a miner of Bitcoin, somebody who actually creates Bitcoin. The Bitcoin is the reward I receive for doing the work to keep the network operational, and that allows me to own a piece of the Bitcoin blockchain. Or take Ethereum, which is easier to understand. The Ether token represents an ownership stake in the network, but on top of that network are all kinds of apps that get built on the network, much like the apps on your phone depend on the underlying network existing that lets the phone operate. And so people will make judgments about which network is likely to win, and they will invest in the tokens in that network much the same way you might invest in Google stock because you think Google is going to scale access to the original internet. The difference being here, you can vote on what happens in the future of a proof of stake network, for example. You can get rewarded through a proof of work token for maintaining a ledger on something like Bitcoin. But the real message here is that what happens on the decentralized internet is decided by the investors, versus what happens on the main internet is decided by Twitter, Facebook, Google, and a small number of other companies.
Okay, so getting this layer on digital assets right, for Congress to understand this, everything is built upon that on-ramp to this new internet. So very important for us to be sensitive to how this develops and any actions we take in terms of laws and updating laws to incorporate these new technologies.
Yeah, Mr. McHenry, couldn't agree more, and I think when you hear about all of the problems of different big tech companies, the importance of an owner-controlled network becomes clear.
Okay, owner-controlled network rather than a cooperative, right? And thinking in those terms.
Absolutely.
Right? So if you're not a part of management, you're not making a decision in Web 2. If you are a participant in the network, you're cooperating in the making of those decisions.
Exactly right.
Okay. So I ask this not to be insulting to the panel, but to have a level set here so we have an understanding of what we're talking about. This is not simply about you on this panel. It is about trillions of dollars of assets that did not exist before Satoshi wrote his white paper 13 years ago. It's about $3 trillion in notional value at this stage around the development of a whole new range, a whole new suite of technology that will be developed across the globe, whether or not the United States embraces it and wants to compete, or if it's pushed offshore. So as policymakers, we need to understand what we're talking about here. This is a small panel, important as you may be, a small panel about the discussion about Web 3. And so with that, Madam Chair, thank you for having this hearing, and I hope that we can have more understanding by policymakers about these important concepts. Thank you, Mr. Brooks.
Thank you very much. The gentlewoman from New York, Mrs. Maloney, who is also the chair of the House Committee on Oversight and Reform, is now recognized for 5 minutes.
Thank you, Chair Waters, for having today's hearing. Our financial system has been built up over time with us learning from each financial crisis, fixing and adjusting as new financial risks come forward. From the Great Depression and the creation of the FDIC and deposit insurance to the Dodd-Frank reforms after the 2008 financial crisis, we may not all agree on every aspect of those laws, but they've made our financial system and our entire economy more resilient and consumers and investors more protected when things do go wrong. In 2018, the New York Attorney General released a report from its Virtual Markets Integrity Initiative, which detailed a few key findings regarding crypto trading platforms on potential conflicts of risk and interest, lack of serious efforts to stop abusive trading activity, and limited protections for customer funds. The report stated, and I quote, "Customers are highly exposed in the event of a hack or unauthorized withdrawal. While domestic or foreign deposit insurance may compensate customers for certain losses of stolen or misappropriate fiat currency, no similar compensation is available for virtual currency losses." This is not a theoretical concern. In fact, Coinbase was reportedly the subject of a hack earlier this year, impacting at least 6,000 Coinbase customers. Ms. Haas, what happens today for a Coinbase customer in the event of a hack of Coinbase or a Coinbase wallet, or in the event of unauthorized withdrawal? What protections does a customer currently have? FDI insurance, commercial insurance, could you answer that question, please? Thank you.
Yes, thank you so much for the question. So Coinbase does secure 12% of the world's crypto, as I shared with you earlier, and we have extensive controls to protect our customer assets. We bifurcate our assets into two different storage systems. We call one the hot wallet, and we call one cold storage. And less than 2% of our assets are held in a hot wallet, which is subject of a cyber attack. Specifically, the incident you mentioned was not a hack of the Coinbase systems, but in that event where customers did lose funds due to other losses, we did reimburse customers for that event. We do protect our customers for any hack of the Coinbase hot wallet, and we have third-party insurance, plus we use our own balance sheet to protect our customers for the event of loss on our platform.
Please pull the microphone closer to you and speak into it so all members can hear you.
Thank you so much for the clarification. With regards to what losses we typically see, though, in the press, we typically see these are account takeovers at the end point where a customer has lost their credentials and then has had a hack of their own phone, their own personal device. And that is unfortunate at this point in time because that loss is not well protected for within the broader crypto economy. That is something that Coinbase continues to study and would look to, over time, do more to support our users for those losses.
Reclaiming my time's very limited. Is that uniform, the protections you talked about, for all crypto exchanges and wallets, or just for yours?
I'm speaking specifically about the Coinbase protections we offer.
Okay, so it's not available to others. So do you think customers could benefit from some uniformity and standardized minimum protections if and when customers lose their funds through no fault of their own?
I do believe there's opportunity there.
Richard? In addition to this committee, I have the honor of chairing the Oversight Committee, and we recently held a hearing on the rise of ransomware and strategies for disrupting criminal hackers. As detailed by a recent FinCEN report, $590 million in suspected ransomware payments were reported by financial institutions in the first 6 months of 2021, and it's getting worse. So it's no surprise to me that these criminals frequently seek payment for ransomware attacks through cryptocurrencies. And FinCEN identified several money laundering typologies for these actors. Ms. Dallaire and Ms. Haas, our anti-money laundering requirements are paramount to prevent fraud, sanctions, invasions, and the financing of terrorism. And you and your companies have highlighted your firm's compliance programs, stating that these standards are important to protect the financial system and to drive trust and adoption. But not everyone in this industry believes that, and many have rejected or avoided compliance standards. Some actively promote themselves on not complying with Know Your Customer requirements. This is an entire financial services ecosystem, and one weak link exposes the entire system to money laundering risk, as highlighted by the FinCEN data I just mentioned. Could you share why your firms have taken your anti-money laundering compliance approach and the benefits of doing so across your firm's products and services? And what steps can we take to bolster our anti-money laundering efforts and ensure all crypto marketplaces comply?
The gentlewoman's time has expired. The gentlewoman from Missouri, Ms. Wagner, is now recognized for 5 minutes.
I thank you, Madam Chairwoman. Ms. Haas, let's continue. SEC Chairman Gensler has indicated on multiple occasions that, and I quote, "The test to determine whether a crypto asset is a security is clear." However, Commissioners Peirce and Roisman noted that they believe there to be an obvious lack of clarity for market participants around the application of securities laws to digital assets and their trading. The lack of clarity is clear through the numerous requests that the SEC receives for these no-action letters. In your view, is additional guidance defining clear rules of the road for investors and market participants needed at this time?
Thank you for the question. We believe this is a very important area of focus for the SEC and this committee. We do agree that the laws are clear. However, existing laws, regulation, and legal precedent make it clear that blockchain tokens are not securities. So we believe that the law clearly shows that blockchain-based digital assets are one of two things: either a new form of digital property or a new way to record ownership, as Brian Brooks spoke earlier about. We do believe that clarity is needed because these are new assets. It's a new way of transacting with these new protocols that we spoke about, and I think it would benefit all of us in the ecosystem to have agreed upon definitions.
I couldn't agree more, and I would hope that Chairman Gensler would be listening to his commissioners and some of the feedback that you all are giving him. You know, we talk a lot about financial inclusion in this committee, and digital assets have the potential to provide fair access to financial services to all Americans, and I believe that Mr. Bankman-Fried brought that up, and many of you did in your written testimony. I'd like to start, and I've got limited time, with Ms. Dixon, and then I think Mr. Allaire. How would digital assets and blockchain technology facilitate financial institutions or financial inclusion and benefit the 1.7 billion unbanked people throughout the world, and particularly the millions here in the U.S.? Ms. Dixon.
Thank you for the question. This is a really important area. Understanding your time is limited, I'll just say that blockchain allows value and money to flow just like email. So it's very simple in terms of how it can get from one point to another, and it does so very, very quickly. The importance of that is it actually can cross borders much more simply than anything else that's out there today. So the value of blockchain is the ability to send from the United States, for example, and send to another country without having to reconcile with all the different software and intermediaries that exist today. So it eliminates intermediaries, it creates less friction in the marketplace, and it allows users who don't have bank accounts today or who choose not to get bank accounts or have been de-risked by banks from being able to be able to access this technology very cleanly because they can do so with a wallet.
Thank you very, very much for that input. And Mr. Allaire.
Thank you, Congresswoman. I think financial inclusion is a critical design goal for many of us, and certainly as we think about USDC, you know, today USDC as a payment technology for dollars on the internet enables users to transfer dollars in a fraction of a second with a transaction cost that can be as low as a 1/20th of a penny, and with the throughput of the Visa network. That's a benefit that can be brought to individuals, and I'd like to really emphasize something for the committee, which is one of the most powerful things about this technology is that it is the open internet. Just like anyone can have an email account or a text message or access the internet, this is an open financial system, and when you combine those kinds of access efficiency and that openness, it creates an opportunity for anyone with a mobile device anywhere in the world to seamlessly exchange value with one another.
Great, thank you. Mr. Brooks, in your view, what should members of this committee keep in mind to avoid hampering innovation, because that's not what we want to do in this new marketplace, and increase the financial inclusion that we talked about here?
Congresswoman Wagner, the answer is one word. It is parity. If we treat traditional financial assets in a certain way, we should not treat internet-based financial assets in a worse way. So for example, if you have a stable coin that is functioning like a payment instrument, it should not be treated differently from a prepaid card or a traveler's check in the normal situation. The answer is parity.
Great. Well, thank you. I appreciate this panel. Thank you very much, Chairman Waters, and I will yield back the couple of seconds that I have. Thank you.
Thank you. Thank you very much. Now we will have the gentlewoman from New York, Ms. Velasquez, who is the chair of the House Committee on Small Business. You're now recognized for 5 minutes.
Thank you, Madam Chair and Ranking Member, for this important hearing. Mr. Allaire, Mr. Cascarilla, it is my understanding that earlier this year, both of your companies stated that your stable coins are now almost entirely backed with cash reserves and U.S. Treasuries. Can both of you confirm that to be true?
Congresswoman Vasquez, thank you for the question. Yes, I can confirm that 100% of the reserves that back USDC are held in cash and short duration U.S. Treasuries.
Mr. Cascarilla?
I can confirm that as well.
Okay. So are both of you stable coins fully 100% backed by cash reserves and U.S. Treasuries?
Yes, that's the case.
Mr. Cascarilla?
Yes, that's right. And I would add one addendum. all of our U.S. Treasuries are maturing in less than 3 months. They are T-bills, so it's very short maturities.
Thank you. And can you please explain why you were offering a stable coin that wasn't backed by fiat currency, and what prompted you to make this change? And please be brief.
Thank you, Congresswoman. USDC has been governed by the money transmission statutes throughout the United States, the permissible investment rules of money transmission statutes, the same statutes that govern the balances of the $35 billion of balances with PayPal or Square or other fintechs. And so we've always been within the statutory requirements. And I think we've reported on that every month since USDC launched in 2018.
Yes. Thank you. Mr. Cascarilla?
So we have always only backed our stablecoin by short-term treasuries or cash and cash equivalents. And the reason we did that is because we have a regulated stablecoin. We're overseen by the New York Department of Financial Services. We operate through our trust company. We have a primary regulator. That primary regulator also regulates our token. And importantly, that primary regulator sets the supervisory agreement with which we're able to then offer our products. Okay. And so this was a statutory requirement for us.
Thank you for your answer. And can you guarantee to the global public that your product is and will continue to be backed fully by the U.S. dollar?
We are committed to a one-for-one backing, and we look forward to working with Congress and federal regulators on ultimately the reserve standards that are really needed for stablecoins as a financial instrument in the financial system.
And Mr. Cascarilla.
Yes, we will always be 100% backed by U.S. dollars that are cash and cash equivalents.
Thank you. Mr. Allaire and Mr. Cascarilla, well, I do appreciate both of your decisions to back your stable coins with cash and U.S. treasuries and voluntarily sharing this with the public. Unfortunately, an investigation by the New York State Attorney General, Letitia James' office earlier this year calls into question the veracity of the entire stablecoin industry and the statement made to the public. Ms. James' investigation revealed for periods of time that stablecoin Tether deceived clients and markets by failing to hold reserves to back their Tethers in circulation, which was contrary to your representation. So my question to both of you is, do you think mandatory reporting of your reserves to federal regulators and submitting to their regular examination is a good idea and something you will each support?
Congresswoman, I am supportive of that federal supervision and of those reporting requirements and mandates, and I think that's critical to make this a mainstream infrastructure that can benefit the U.S. economy.
Thank you. And Mr. Cascarilla?
It's important to say that we are regulated as a trust company. We are a regulated financial institution. We have been since May of 2015. We were the first one in the entire country, and we're proud of that. And so our products already have a primary regulator that oversees our issuance. That's different from everybody else.
Excuse me. Maybe I omit in my question federal regulators. Mr. Allaire?
Yes, we are supportive of federal supervision.
Good. And Mr. Cascarilla?
I think federal supervision can make sense, especially for firms that don't have a state regulator that oversees their activities.
Very good. Thank you. Ms. Haas, Mr. Backman-Fried, digital asset trading platforms like yours play an important role in the current functioning of stable coins and therefore also raise broader questions about digital market regulation, supervision, and enforcement. Can each of you describe the method your platforms use to determine the price for exchanging virtual currency for fiat currency? I see that my time has expired. Thank you. I yield back. Time? Okay. Ms. Haas.
Coinbase is an agency-only platform. We do not engage in proprietary trading on our platform. All prices established on our platform are due to market makers, so we offer a platform for customers to come together to offer bids and asks on a variety of currencies that we offer on our platform. So the market price is determined by the market participants.
And at what stage of the transaction do you provide an assurance of or lock-in of an execution price?
So we have two products. We have a consumer product, and we have what we call our pro product for our institutions or more advanced traders. It's important that any customer can choose either platform, but we tend to see consumers choose our easy-to-use consumer platform. The price displayed on the screen to the consumer is the price that's locked in and that we guarantee to the customer.
Thank you.
Thank you. The gentlewoman's time has expired. The gentleman from Oklahoma, Mr. Lucas, is now recognized for 5 minutes.
Thank you, Madam Chair. Ms. Haas, you discussed in your written testimony how the future of blockchain might include new areas of tokenization, such as property, titles, even people's time. Could you discuss further what trends you currently see and how new asset classes could arise through blockchain technology? Where are we going?
Thank you for the question. So I think it's important to share that anything can be tokenized, any item of value. And this is the internet of value that we're talking about with Web 3.0. So the early things that we're talking about are the protocol layer. Over the protocol layer, we see infrastructure being built, and then we see applications being built as the next layer. So Bitcoin, Ethereum, Stellar, Solana, these are all important protocol layers that we're talking about. And on top of these, we see applications. So an interesting article was published yesterday that gaming platforms, so video games that many of you may play, your children may play, gaming where NFTs, non-fungible tokens, which means they're different, every token is different. Think about a shield or a sword or something of value, are being most accurately traded. And it was a significant percent of the assets in DeFi, decentralized finance, in November were traded in apps. And so we're seeing all types of things. We've had early conversations with real estate developers to get broader global liquidity, more liquid markets for tokens. We've seen a lot of innovation in the payment space and a lot of innovation in NFTs with digital art. But this is just the tip. And I think just like back in the early 90s when we were thinking about the internet and we couldn't envision Uber, we don't know what the future is. And there's so much ahead of us.
Fascinating. Mr. Brooks, it's good to see you before the committee again. Could you discuss what key fundamental differences between banks and stablecoin issuers are important for Congress and regulators to understand when looking at regulatory proposals?
Sure. Well, Congressman Lucas, thank you so much, and it's nice to see you again as well. One of the historical differences between banks and stablecoin issuers is that banks in this country historically have been engaged in multiple different kinds of financial intermediation and risk-taking functions. Banks typically engage in 3 different things: deposit taking, lending, and payments. The core feature of stablecoins is they're a new payments technology, and payments are one of the core things that banks do, right? So banks historically innovated in payments by first having check clearing, then later having traveler's checks, then later having prepaid cards and things like that. Stablecoin is just the faster, most modern way of transmitting those values. Stablecoin issues, of course, don't present all of the risks that banking presents. They don't typically engage in lending or anything else. And this is one of the reasons why at the OCC we looked very carefully at the possibility that payment companies like American Express in a different generation, Circle today, might possibly qualify for bank charters. They're engaged in a core banking function, but not in the other banking functions. It's to my point earlier that sometimes crypto is reducing risk, not increasing risk.
Ms. Dixon, could you also discuss this for a moment?
I think that there's a really big opportunity with respect to blockchain. I think when you mentioned before about tokenized assets, there already are tokenized interest in real estate that exist on Stellar, for example, or in fractionalized interest in U.S. stocks. So there's opportunity for growth there. With respect to what we have with blockchain and what can be accessible, that banks already have available out there, but when they de-risk populations and they de-risk individuals out of the banking infrastructure, they can actually access accounts, hold their assets in a digital framework, and then do a lot of the same things that you can do at banking institutions, but these individuals couldn't get access to it before. So I think blockchain creates that financial inclusion that we're all talking about and that we all want to get to. And it does so, I think, with, as Ms. Haas indicated, with the different layers, the infrastructure layer and the application layers, there's so much creativity that's happening now. So I think we have a long road ahead of us with respect to this technology.
Mr. Bankman-Fried, could you respond to the criticism that stablecoins would be ripe for illicit financial activity, and could you compare this risk with other payment rails?
Thank you, Congressman. We, as do most market participants in the digital asset ecosystem, have advanced surveillance techniques to prevent financial crimes for all digital assets, including stablecoins, conducting know your customer policies and blockchain surveillance on all users and deposits and withdrawals through our platform. And all legitimate stablecoin issuers, in addition to that, conduct sophisticated know your customer policies on all issuers, all issuances and redemptions of those stablecoins. If you compare that to, for instance, physical cash, where no transactions effectively have know your customer or anti-money laundering or anti-financial crimes surveillance on them, already I think that the digital asset industry has set a pretty strong standard on that front.
Thank you. Madam Chair, I yield back.
The gentleman from Texas, Mr. Green, who is the chair of the Subcommittee on Oversight and Investigations, is now recognized for 5 minutes.
Thank you, Madam Chair, and I thank the witnesses for appearing as well. I trust that my volume is such that I'm being heard. If you can verify, I would greatly appreciate it.
We can hear you very well, Mr. Green.
Thank you very much, Madam Chair. In the last year, the digital asset market has exploded from about $500 billion to $3 trillion. And there's still extreme volatility, it seems, in this marketplace. Bitcoin, for example, lost half of its value over 2 days in March. And it rebounded, of course, later on. But there are many problems leading up to the global financial crisis that seem to be manifesting themselves in the market currently. Easy credit via margin investing, lack of transparency, the lack of transparency that I'd like to see, and adequate financial disclosure is not readily available. With the explosive growth in cryptocurrencies, at what point should we become concerned about the possibility of a bubble? At what point should we become concerned about the possibility of a bubble? Let's start, if we may, with Mr. Brian Brooks.
Well, thank you, Congressman Green. It's terrific to see you again, and I always find your questions extremely perceptive. What I would say about that question is a lot of the price volatility of cryptocurrency has to do with the early stage of the market and the thinly traded nature of the asset compared to, for example, U.S. real estate, global equities, or anything like that. I think the message I'd land with this committee in response to your question, however, is some of the things that make U.S. equity and debt markets more stable and less volatile have to do with the fact that there's a lot more price discovery in those areas. And what I mean by that is, you know, in the U.S. we have regulated equity mutual funds. We have derivatives products and futures products that allow the free trading on a 24/7 basis that provides the market with forecasts of what's happening in the ecosystem. In the world of crypto, the U.S. hasn't responded by developing those tools for price discovery yet, and so the result in a relatively new, relatively thinly traded market is that one person unwinding their position can have a massive effect on the price. The last point I would just make